Yes, a very good morning to all of you. Right? So, is it that your faculty had given you some homework yesterday? I was waiting, I said that, okay, my good morning has gone to all of you. So, I will receive the charts for the chapter that we studied yesterday. Right? Did we study a chapter yesterday? Yes, we completed with the chapter on the audit of the consolidated financial statements, right? And if you've prepared a chart, would be lovely to see that chart of the summary I told you, so that you have the summary or a snapshot of the entire chapter, something like that. Okay, right? So audit of the consolidated financial statements, which is now called as the group audits. That means you're doing the audit of the group financial statements and not doing the audit of the standalone financial statements. Okay, right? So first we have to get the terminology right. Like, what is the terminology over here? It is the parent company, then the parent company auditor, then you have the components, then you have the component auditor. Component auditor, it could be the same auditor or it could be a different auditor, right? It could be the same or it could be a different auditor. If it is a different auditor, then you need to apply the Amul butter. You remember, where is Amul butter? How much grams of Amul butter do you need to apply? 600 grams. Why 600 grams of Amul butter you need to apply? Because SA 600 using the work of the another auditor. Exactly. Right? SA 600 using the work of another auditor. Okay. And then we went to section 129 of the Companies Act 2013, wherein it is now mandatory to prepare consolidated financial statements as per the company law. Earlier it was only the AS, Ind AS, which used to mention about the CFS. Right? But now company law, what does it say? Okay, in case if a company is having the subsidiary, associate, joint venture, in addition to its standalone financial statements, it shall also prepare its consolidated financial statements in the same format in which it prepares its standalone financial statements. So like, if standalone financial statements have been prepared as per the accounting standard schedule 3, even the consolidated financial statement should be prepared as per the accounting standard schedule 3. Okay, but then we understood that in the accounting standards or in the Ind accounting standards, there are certain criteria for exclusion of a particular subsidiary from consolidation. Like in AS, there are two exceptions over there. One, the control is intended to be temporary, for disposal in the near future. And second one, right, there are severe long-term restrictions on the transfer of the funds. Then what does it say? No need to consolidate this particular subsidiary, right? So say if a company is having a subsidiary in which they have a temporary control, then does that company need to include that subsidiary in the consolidated financial statements? No. So say that's the only subsidiary they have, then do they need to prepare consolidated financial statements as per the AS? No. But still, will you give the disclosures as per schedule 3? Yes. But then we said, as per schedule 3 also, disclosures are not required to be given if the three conditions are fulfilled. Right? That the members, yes, for a partially owned company, do not object the company not preparing the consolidated financial statements. Then the company is not listed or not in the process of getting listed on any stock exchange in or outside India. And the ultimate or the intermediate holding company has prepared and filed the consolidated financial statements with the registrar. Right? So if required by AS, you prepare as per AS and schedule 3. AS says no, you still give the disclosures as per schedule 3. And if you meet these three conditions, then no need to give the disclosures as per schedule 3 also. Right? So that was under the AS. And then we came to the discussion regarding the Ind AS. Right? Under Ind AS, what are the exceptions we saw? Who need not prepare consolidated financial statements? One, the investment entity. When the parent company itself is an investment entity, it says it need not prepare the consolidated financial statements. What is an investment entity? Which is taken the funds from the investors for providing the IMS, the investment management services. Then what is their aim? Capital appreciation, investment income, or both. And then what does it say? It does not carry out, right? What does it say? No other activity being carried out. And they measure all their subsidiaries at the fair value. Right? Very important. They measure all their subsidiaries at the fair value. Right? So investment management services, capital appreciation, investment income, or both, and measure all the subsidiaries at the fair value. Then it says you are a investment entity, and then it says no need for you to prepare the consolidated financial statements. And second, we said that's intermediate subsidiary company. Again, that intermediate subsidiary company need not prepare the consolidated financial statements as per the Ind AS. Right, so no need to prepare as per Ind AS, but then still you need to give the disclosures as per the Schedule 3. And if you meet those three conditions, then no need to give the disclosures as per the Schedule 3 also. Right, so if required by Ind AS, then Ind AS and Schedule 3. Ind AS says no, then still Schedule 3. And Schedule 3 also not required to give the disclosure for CFS if the three conditions have been fulfilled. I hope everybody understands this question. This question has come 5 to 6 times in your exams. Right, regarding the parent company has a subsidiary, but the investment is with an intention to dispose of in the near future. So we said you don't need to consolidate as per the AS 21, but you need to account for it as an investment as per AS 13. However, exemption for temporary control is not there under the Ind AS. It is only there under the AS. Right, so and then you need to say section 129 says that even though if the as per the accounting standard the company is not required to prepare the consolidated, still they have to give the disclosures as per Schedule 3. And then you say if the company is following AS, then it says only Schedule 3 disclosures. And if they are following the Ind AS, then they have to prepare the consolidated, because exemption for temporary control is not there under the Ind AS. Right? Temporary control and severe long-term restrictions on the transfer of the fund, that is there in case of the, right, that is there in case of the AS. It is not there in case of the Ind AS. Okay, right, so that was one part of the discussion. Okay, consolidated financial statements now mandatory under the Companies Act 2013. Okay, then after that we saw the responsibilities. We saw the responsibilities of the parent and the responsibilities of the auditor. What are the responsibilities of the parent? Yes, karta. Right, the karta of the family, what is this responsibility? Identify all the components, identify the reportable segments, identify the related party transactions. After these three identification are done, then obtain the accurate, complete information from the components, then do the consolidation procedures, the consolidation adjustments, then harmonization of accounting policies and gap conversion in case of the foreign components. These are all the responsibilities of the parent, that is the management of the parent company. Right, then we talk about the responsibilities of the auditor to express an opinion on the true and fair view of the consolidated financial statements, then to check whether consolidated financial statements have been prepared in accordance with the AFRF, right? Then 143.1, 143.3 even applicable for the consolidated financial statements. And then after that we came to the audit considerations. Right, so this was responsibilities of the parent, responsibilities of the auditor. Then we came to the audit considerations. What are the two big concerns for the auditor? Two concerns, two considerations for the auditor. One, whether consolidation has been done in accordance with the AFRF. Absolutely right. Right, whether consolidation has been done in accordance with the AFRF. And second, whether few of the components have been audited by a component auditor. So in that case, you need to use the work of another auditor, SA 600. Right, then we talked about a retail question over there regarding the concept of materiality. Right, so again 2-3 times question we have seen on this one regarding the concept of materiality. So one, what does it say? Parent company auditor, you will determine the materiality for the group as a whole. Second, parent company auditor, you will determine the materiality for each component. Third, parent company auditor, you will determine whether any component is not material. Right, so materiality for the group, materiality for the component, and also any component which is not material. Then it says you also obtain the confirmation from the component auditors regarding their compliance with independence, statutory requirement, ethics, and so. And then what does it say? While the parent company auditor is considering the observation comments in the audit reports of the component auditor, should the parent company auditor apply the concept of materiality? Should the parent company auditor apply the concept of materiality while considering the qualification, adverse remarks in the or emphasis of matter paragraph in the audit reports of the component auditor? Yes. Right, the parent company auditor needs to apply the concept of the materiality. Right, so that is an important discussion over there regarding using the work of the component auditor. Right, then after that we came to auditing the consolidation. That is, now actually we do the audit of the consolidated financial statements. But obviously, to do an audit, first we need to plan. And in the planning, what is the first thing you need to do? You need to understand. What you need to understand? The group and the group account, group structure. Right, the group account is the group wide structure, the group wide controls which are there. Right, then understand the accounting policies. Are they uniform, or is any harmonization of accounting policies required? Right, so you understand the group, you understand the accounting policies. Then once understanding is over, now you determine the nature, timing and extent of the audit procedures based on the assessment of the RMM. Then you determine the extent to which you need to use the work of the component auditors. And finally, you need to coordinate the work to be performed. Right, coordinating the work to be performed. Okay, right, so that is planning and audit. So this has been asked as a separate question in your exams, planning and audit of the consolidated financial statements. Okay, right, then after the planning we came to the audit procedures. And in the audit procedures, what was our hero word over there? What was our, like a very important term over there for all the points in the audit procedures? It was the components, right? Components, right? So completeness of the components, listing of the components, all components, exclusion of component, reason for exclusion of component, change in the status of component, right? So all points regarding the components. And then we also saw a retail question regarding the completeness of the components, right? To check whether all components have they been included or not. Right? Because what did I tell you? What is the style of the auditor? Directly ask, indirectly check. Right? You directly ask how many related parties, but will you also indirectly check? Yes. So you need to check for the completeness. So one, what you do, you review the prior year working papers, right? Then you review the parents' procedures to identify the components. Then you review the investments made during the year, the joint venture agreements entered during the year, the other arrangements made during the year, the minutes of the meeting, the shareholder register, statutory records, right? So these are all the records which can help you to check the completeness of the components. Right, then we talked about the company accounting standard rule and the company Ind AS rule. Then about the de facto control. Okay, though you are having only so much of the voting right, but unilaterally you are able to influence the decision making of the company. Right, then there are a lot of off-balance sheet entities, right, where the profits and sales of the company have been transferred. Right, so you need to check whether there is any de facto control. And then after that we talked about the consolidation adjustments and the no separate disclosures. What is this question regarding the no separate disclosures? Okay, these disclosures, though they are given in the standalone financial statements of the parent company and the components in the separate financial statements, when the consolidated financial statements are being prepared, that time these disclosures need not be given in the notes. What are the disclosures? Sources from where you issued the bonus shares, then how you utilized your unutilized money from the issue proceeds. No need to give it in the notes of the CFS, right? Then disclosures relating to the MSMED, then the statement of the investments, no need to give. Right, then the value of the imports on the CRF basis, then value of the imported raw material and the indigenous raw material, right? Then the expenditure in foreign currency, then the amounts remitted in foreign currency, being the dividend being paid to the non-resident shareholders. And then after that, last one was the earnings in the foreign exchange, right? The earnings in the foreign exchange. It says these disclosures, though they are there in the separate standalone financial statements, they need not be included in the consolidated financial statements ka note. Okay, and then after that we came to the discussion regarding the consolidation adjustments. We had two types. What were the two types? PCA and CPCA. What is PCA? Permanent consolidation adjustments, and CPCA, the current period consolidation adjustments, right? Permanent consolidation adjustments which arise on the first occasion and any subsequent occasion when the consolidation is being done. Right? How many permanent consolidation adjustments? Only two. And a goodwill or capital reserve arising on consolidation and the equity attributable to the NCI. And then we talked about the verification, right? You need to check the calculations, the date, the pre-acquisition reserve, any acquisition, disposal of share, goodwill, capital reserve. It can be net off where it is permitted by the AFRF. Right, so that was regarding the permanent consolidation adjustments. Then we came to the discussion regarding the current period. Right, so for the period for which consolidation is being done, that time those adjustments are required to be made. That is why we call it as each occasion. Okay, every time you prepare consolidated, every time you may have to do these adjustments. Right, so what are the current period consolidation adjustments? You remember current period? We had prepared, groups over there. You remember? Yes. Yes, current period consolidation adjustments, intra-group profit, intra-group interest, intra-group indebtedness, and all this you need to eliminate. Right, then after that the harmonization of the accounting policies. Right, then after that what point we have is the harmonization of the accounting policies or the gap conversion in case of the foreign components. Okay, right, then after that we said the subsequent events between the date of the financial statements and the date of the audit report. Then different year ending dates, that the components year ending date is different. Right, then you need to perform procedures. The management needs to check for the significant event or transactions, right, after the date of the audit financial statements of the component and the date of the financial statements of the parent company. Right, then it says you need to check on the deferred tax which is coming on the intergroup profits, then also the deferred tax which is coming due to the timing differences, right, the temporary differences. Right, then any changes in the equity attributable to the NCI, and then last one is the impairment losses on the goodwill arising on the consolidation. Right, so that goodwill which has arose on consolidation, whether any impairment of the goodwill is to be recognized. Right, any impairment losses on the goodwill arising on the consolidation. And then after the CPCA, we talk about the verification. Right, so again all these similar points, but only now you need to write down verify. Right, the elimination of intra-group transaction, then check whether the uniform accounting policies, if they are different accounting policies, then again, and it is not practicable to harmonize them, then whether the disclosure have been given in the notes. Right, so all that disclosures like verification is required to be done. Okay, and then we came to the last part of the discussion in this chapter, which was regarding the reporting on consolidation. And under reporting on consolidation, how many heads did we have? How many heads? 5 heads, right? What were the 5 heads? When parent company auditor is the auditor of all the components. Second, when parent company auditor is not the auditor of all the components. Third one, the component has prepared its financial statements under a different accounting framework. Fourth one, the components have been audited under a different auditing framework. And the last one, few of the components are not audited. Right, few of the components have not been audited. Okay, right, so now first one, what is the first one over there? Parent company auditor is the auditor of all the components. What you do? Simply express an opinion on the true and fair view, right, of the consolidated financial statements. Situation 2, when parent company auditor is not the auditor of all the components, you will apply 600 gram of Amul butter. That means you will apply SA 600 using the work of another auditor. Now in your audit report, you will put a other matter paragraph. In that other matter paragraph, you will mention the total revenue, total assets, net cash inflow or outflow, the magnitude of portion which has been audited by the other auditor. And is this to be considered as a qualification in the audit report? No, it is to be considered as a clarification. We see in a question number 33, Badnaam and Company. Right? It is not to be put as a qualification. It is to be put in the other matter paragraph. Okay, right? Then third one, okay, components have prepared their financial statements under a different accounting framework. Right? So now what does it say? First, the parent needs to do the conversion. Then as an auditor, you need to verify the conversion adjustments which have been done by the parent, right, by the management of the parent company. And then in case if there are any group accounting manual, then whether the policies as given under the group accounting manual have they been followed by the components, right? So that is different accounting framework. Then we had different auditing framework. What we need to check whether the different auditing framework, does it correspond to the generally accepted auditing standards in India. Okay. And last one, few of the components are not audited. So if they are not audited, we need to check whether that component which is not audited, is it material to the group or is it not material to the group? If it is material to the group, then 705. What is 705 over here? Limitation on scope. What is that? Qualified opinion or disclaimer of the opinion. And in case if the component is not material to the group, then other matter paragraph. Right, then the other matter paragraph. Okay, right. So still I'm hopeful of receiving any chart for the chapter of CFS. Yes. Or it will be like, dil ke arma aansuon mein beh gaye. Okay. I was so optimistic that, I will see at least one or two or few charts from the students where they have consolidated the chapter on the consolidated financial statements. Okay, no worries, right? You still have the time is still on your side. Okay, it's not that the exams are over and then nothing can be done about it, right? So still I'm waiting for you to, prepare the chart and so, okay, right. Then after that we came to chapter number 2. From 13 we took a flight and we went flying to chapter number 2. In 2 we started walking backwards. We've already completed with 402. Then we came to essay. Which essay? I don't know. Which essay? 299, right, which is regarding the joint audit of the financial statements. Okay, right. So joint audit, where more than one firm of auditors has been appointed to do the audit of the financial statements. Okay, so now joint auditors, what you will have to do, you will have to prepare a joint audit plan. Right, so joint audit plan, what are the factors to be considered in the development of the JAP, the joint audit plan? So one, MD. What is MD? Mutual discussion. They will decide upon the division of audit areas and the common audit areas. Then what did we say? It's very rare that 24 joint auditors are appointed, like what we saw for State Bank of India. Right? So why rare? Because we set the reporting objectives. Then after that, the results of the preliminary engagement activities. Then the nature, timing and extent of the resources required to perform the engagement, and professional judgment as to which areas are significant in directing the engagement team efforts. Right, so reporting objectives, activities, resources, and then the efforts. That is the RARE. And then we said each joint auditor will identify, assess the RMM for his area and communicate it to the other joint auditors. Right, so that was the joint audit plan. Then this division of work, which has been mutually agreed upon by the joint auditors, it should be documented on a piece of paper, and that piece of paper is called as the WAD, the work allocation document. Why it should be prepared? To avoid any dispute or confusion among the joint auditors or between the joint auditors and the client. Though it is a joint audit, what does it say? Common engagement letter and the common written representation letter. Then we talked about the responsibility and the coordination among the joint auditors. Right? So one responsibility, what do we say? For work which is divided. Right? Who will be responsible? The respective joint auditor to whom that work has been allocated. And then we have certain areas where the joint auditors are J and S, JUS. And they are jointly and severally responsible. Right? So what are the areas where they are jointly and severally responsible? One student had said yesterday, FR done, FM done. I had said dahi, doodh, makhan, fal, fool, ration. And so what do we say? What are the areas where they are jointly and severally responsible? Work which is not divided. Then deciding upon the nature, timing and extent of the audit procedures for the common audit areas. Right? Then after that, we say that the matters relating to all brought to their attention by any one of the joint auditor. Where the financial statements comply with the requirement of the statute. Where the presentation disclosure of the financial statements is it in accordance with the AFRF. whether the audit report is in compliance with the statutes and the pronouncements of the ICAI, and obtaining information explanation from the management unless they've agreed on a specific pattern of the distribution of the responsibility, right? So these are the areas where they are jointly and severally responsible. Okay, 99.99% of the time they agree upon a common report to be issued, right? So they issue a common audit report. But in case if there are differences of opinion among the joint auditors, the joint auditor having a different opinion may report separately, not bound by the views of the majority of the joint auditors, right? So separate audit report can be issued by the auditor having a different opinion, not bound by the views of the majority of the joint auditors. But in case if there is a common audit report and there is a separate audit report, what do they say? That you have to make a reference to each other's report in the you have to make a reference in the common audit report, make a reference to separate audit report. In the separate audit report, make a reference to the common audit report. In the other matter paragraph, right? Where to make the reference? To make the reference in the other matter paragraph. Okay, right? So that completed our discussion on SA 299, right? Most important question over there is that JAS. What is that JAS? What are the areas where the joint auditors are jointly and severally responsible, right? So we say dahi, doodh, makhan, phal, phool, ration, right? So DDMFFR, right? That is what we said for the jointly and severally responsible. Okay, right? So today we have a standard day. Right? Why we have a standard day? Because we have a complete discussion regarding the standards in the chapter number 2. Right? So we'll first look into the question bank of SA 299, then come to SA 260, then 250, then 240. Right? So that's going to be our agenda for today. Okay, right? So let's begin.